year or so. Think about it.
Well, Scott, I think your last point is the key point, because what that reflects is often when we see these massive platform changes, we tend to underestimate on the front end what the potential demand is going to be and the ultimate size of these markets. So I think from a financial analysis perspective, the analysts are looking for these investments to be the indicator that there's more demand, which will be reflected in top line growth. But I think ultimately there's a little bit more patience for how that's going to translate into margins once we start to see some of these higher margin businesses begin to really be the drivers, which they're already growing and trending in that direction.
Is there one? I want to take Apple out of the mix for a moment because it's different.
Right.
It's different
Yep.
in the way that they spend. It's different in the way that we think about what AI is ultimately going to mean for them. Is there one of the Microsofts or Metas or Amazons that are coming next week that gives you any level of pause at all?
I don't think necessarily a level of pause. However, what I will say, when you look at the CapEx spend of Google Alphabet that was announced, I would look for similar increases potentially, number one, across both Amazon and Microsoft. And then I would also look to see if there's any guidance on what the backlog looks like that's driving that increase in CapEx spend. Now, Meta is a little bit of the outlier. Like when we think about CapEx spend, Amazon's projected to do about 100 billion this year. Microsoft is just about in line with Google at about, call it 80, 85 billion. Meta is spending probably about 70 billion this year. But what's interesting is when you think about Amazon, Microsoft, and Google or Alphabet, those CapEx expenditures are primarily to support their hyperscaling business, the cloud business. Meta is making that investment so they can offer a better user experience. So that's the one that I might watch, because if I were an analyst, to your point, again, when I think about the CapEx expenditures for Amazon, Microsoft, and Alphabet, okay, those are in line with the customer demand. Meta's a little bit different. So I would look for a little more guidance and understanding around how those investments are going to translate into dollars.
We know, I'll ask you lastly about Apple. We know they have a lot to prove. Yeah, that's not breaking any new ground. But what would be new ground for them would be a deal of scale. Is there real chatter out there in the circles that you roll in about them doing just that? I mean, Perplexity's thrown around all the time as a possible place that they could look. People speculate about that anyway. What do you know?
Right.
What do you hear? What do you think?
Yeah, the Perplexity name continues to come up. I think, again, the thing that we're seeing is there is a little bit of sniffing around in terms of Apple breaking from their normal vertical integration model, which is to build everything from the hardware all the way to the software, where the user has that experience and maintain tight control. But they're so far behind, as we discussed before. Yes, I would anticipate that there could be an announcement up soon that would be a major break for Apple and a major acquisition. And if it happens, it's without question going to be around AI.
Right, because historically, you make this point, I think just now, they're so used to doing things organically in-house in the way they do everything. And
Right.
this is just not that. They
Nope.
probably need, and maybe they're coming to the realization that they need to do something outside.
Correct.
We'll see you soon, Lo. It's fascinating. We'll see what happens next week, and I know we'll talk to you soon. Lo, Tony.
Thanks for having me.
All right, coming up next, Mohamed El-Erian. He says Fed Chair Powell needs to resign. He said that would be better for the Fed's independence. We'll debate it next. Our next guest among those who've said publicly that Fed Chair Powell should resign as he faces continuing criticism from the president over his policy decisions. Mohamed El-Erian is Allianz chief economic advisor. He joins me now. It's nice to see you. Welcome.
Thank you, Scott.
I want to debate this because I'm trying to get my arms around this notion that the Fed chair should resign with the markets booming, the economy strong, credit calm, and the only potential issue has nothing to do at all with his own policy. He didn't put the tariffs in place. So why does it make sense that he should resign now?
It's all about preserving the independence of the central bank. That is the guiding principle. Look, as you can imagine, I've discussed this with lots of people in markets, in the policy world, and they split into two, Scott. Those who vehemently disagree with me and those who agree with me but don't want to go public. We all agree on the importance of central bank independence. We all agree that we are far away from the first best, whereby Powell completes his term and doesn't get attacked. What we disagree on is, in the world of second best, what is the least costly option for the Fed? Is it Powell staying and the attacks not just deepening but widening? You saw Speaker Johnson get into the act this week, and you risk a fundamental long-term damage to the independence of the central bank. Or alternatively, he steps down, de-escalates the situation, and yes, there is a cost to independence in the sense that the chair has stepped down, but you don't get the deep intrusion into the institution that undermines its operational autonomy.
I just don't get it. I mean, so he should leave because he's being attacked by the very person who put him in the job in the first place? The precedent of that, alone is slippery.
He should leave because he is the magnet of a growing number of investigations into an institution that risks losing its independence. That's why he should leave. He should have the independence of the central bank as his primary objective right now.
What do you mean the growing number of investigations? The building? I mean, come on. It's like,
okay,
would we be talking about the building if he was about ready to cut rates?
So let's talk about the building. You had Secretary Bessent talk about the need to investigate non-monetary policy issues. You had Speaker Johnson talk about maybe we should look into the act, and that's a very consequential statement. You have a ton of things hanging over the Fed: the policy mistake of inflation, the banking issues in California, the allegation of insider trading. There's a ton of things that people can investigate, and in the process, they will weaken the independence of the central bank. This is way beyond the building. It is what Steve Bannon called attacking across the board. So yes, I am worried about the independence of the central bank.
And then the next person who assumes the role doesn't do what the president wants. He takes the incoming fire, and then what happens? We just repeat ourselves over and over and over and over in a job that is supposed to be the most independent of politics in Washington.
That is the risk. But again, I stress, Scott, when you're in the world of second best, you need to figure out what is the least costly option. There is no first best. We all would love to have a first best. We all would love for Chair Powell to finish his term in May and for the Fed not to be attacked. But that's not the world we're living in. And I doubt you believe that that's the world we're living in.
Do you think he's been a good Fed chair?
I think he's made some major mistakes. I think the transitory inflation was a mistake. I think the late in hiking interest rates was a mistake. I think what happened to the banks in California under the very nose of the supervisors, that was a mistake. And his communication hasn't been that good. There are lots and lots of studies that show that when he is in his press conference, the market is much more volatile than it's been under any other Fed chair.
Who should get credit for the fact that through all of this, the thick and thin of inflation and hiking and this, that, and the other, that I got the market here at a record high, extending it. The Dow may close at a new record high. The labor market has remained solid. As I said, the credit markets have remained calm. He and they don't get any credit for where we are through all of that. Not to mention the fact that most of this happened post-COVID, and it was skewed by the events of COVID itself. He didn't cause the supply chain issues that happened during the pandemic, and then he had to deal with it, not to mention what many have said is the flawed policy of the prior administration, pumping all of the money into the system on top of money, on top of money, on top of money. He didn't do any of that. He had to deal with all of it, though.
He was late in reacting. Look, he warned us in August 2022, you will remember this, about pain. He expected the economy to go into recession. It has surprised us. Who are we thankful to? Corporate America. Earnings, innovation, strong balance sheet, entrepreneurial. We have outpaced every single other advanced economy. It is about corporate America. And the marketplace is making a very rational bet. It says, I know the sovereign side is messy. Trade tariffs, the Fed, I know it's messy, but I'm going to focus on corporate America. And this ability to differentiate between corporate America and sovereign America is the reason why we are going to have a 13th record high. And if you don't believe me, look at where gold is. Look at where the dollar is. The gold has hit record after record, and the dollar is still languishing. So if you look at anything associated
the president
with
wants
America,
a weaker dollar. The president wants a weaker dollar. He said
Right.
as much on the air today. We heard him outside the White House wax about what the benefits of a weaker dollar are, almost paying, oh, yeah, well, a strong dollar. I believe in, king dollar, strong dollar, all that. But there was always the but. A weaker dollar lets us do that, or it makes the tariffs this. Maybe he wants a weaker dollar.
Oh, there's no doubt he wants a weaker dollar, but he cannot produce a weaker dollar. He may want a weaker dollar, and he wants it because it's easier to sell abroad. That's what he said today. But the weaker dollar is a reflection of people's uncertainty outside the U.S. about what's going on in the U.S. This policy-induced uncertainty is at very high level. That is why the dollar is weak. That is why gold is doing what it's doing. But thankfully, the marketplace, equities, distinguishes between corporate America and sovereign America.
Who should the next Fed chair be?
I mean, there are great names on there. I think Kevin Walsh would make a very good chair. And there are others, Chris Waller, possibly Scott Bessent. There are good names there. We don't lack good candidates with a lot of experience.
Mohammed, we'll leave it there. It's provocative, that's for sure. And the conversation, I know, will continue, and I hope it does with you. Thanks.
Thank you, Scott.
All right, up next, we track the biggest movers into the close. Christina's back with that. Tell us what you see.
Scott, there's two companies making major market moves. One just joined the ranks of the 20 most valuable companies in the U.S., and the other's a new drug could become a multi-billion-dollar blockbuster. I'll have those details right after this short break.
and make it count.
Are about 10 out from the bell. Back to Christina now for the stocks that she is watching, starting with
Palantir, because it just joined the ranks. Sorry, I've got really excited. I don't know why. It's Friday. Of the 20 most valuable U.S. companies, I wish I was a shareholder. The stock hit another record today on Friday, up about, look at that, almost 3% after Piper Sandler started coverage with an overweight rating. The firm pointed to Palantir's unique growth story and strong demand from defense as well as data customers, saying the valuation is high, but justified. Gilead Sciences also just got an upgrade from Needham, telling investors it's a buy thanks to growing optimism around its new HIV prevention drug that would be yet to go. A recent physician survey suggested this twice-a-year injectable drug could grab more than a third of the market by 2030. I may have butchered the name. That's why the analysts believe this drug could become a multi-billion-dollar revenue driver for Gilead just in the years ahead. Scott.
All right. Christina, thanks. Christina Parts-Number. Still ahead. We'll tell you what's behind the big bounce today in Deckers. Closing bills coming right back.
To find a place.
We're now in the closing bell market zone. Courtney Reagan's tracking a huge move today for Deckers. Julia Borston following Charter, on pace for its worst day ever, and Pippa Stevens is following some major moves in the oil patch today. Cora, we begin with you. Tell us about Deckers.
Hi, Scott. So usually in U.S. retail, company shares rise or fall based on the success or not of the domestic business. But for Deckers, the gain today is really tied to its international sales, well outpacing the U.S. business. Bullish shareholders should be pretty happy today. But it's been a tough year for the stock, down about 42% year to date. So international for Deckers sales grew 50%. The U.S. business up, but just about 3%. Deckers wholesale grew 27%, while its direct-to-consumer business about flat year on year. Now, Deckers owns a popular running shoe Hoka brand, UGG and Teva brands. Those are probably the most popular. Hoka sales grew 20% in the quarter. UGG grew 19%. Both a bit of a surprise because the footwear maker had given some pretty disappointing guidance in May for this quarter. Now, Deckers did raise select prices as of July 1st due to tariffs, with more coming, and says a 20% tariff rate for Vietnamese imports would be $185 million of an unmitigated impact. That's up from its prior estimate of about $150 million. Now, Deckers didn't provide full year guidance due to macroeconomic certainty, but I guess investors are looking the other way on this one, focusing on the good. Scott?
All right, Court, thanks so much. This is Courtney Reagan. Julia, tell us about Charter. It is the worst stock in the S&P. It's taken a lot of other names down with it, too.
Yeah, it's on track to have its worst day ever in the history of the company, down last check about 18%. This after reporting earnings that fell short of expectations. The company also reporting the loss of 117,000 broadband and 80,000 video subscribers in the quarter. Now, with today's declines down 18.5%, Charter is now down about 26% since its merger with Cox Communications was announced in May. Just to put that in context, the S&P is up 8% in that time period. Now, this report is also dragging on other cable stocks. Comcast, Altice, and EchoStar, which owns Dish, also lower on Charter's indication of weakness in the space. Now, one sliver of hope. Charter echoed comments that AT&T and Verizon made earlier this week, saying on its earnings call this morning that new tax legislation will save several billions of dollars in taxes over the next 5 years, which will help finance their capital expenditures, among other things. Scott?
All right, Julia, thank you. Julia Borston, Pippa Stevens, tell us what you're watching.
So, Scott, the services sector down a bit today, but still gaining 8% on the week. The oil services names for the best week of the year after earnings have been better than feared. Now, some solid results have come against muted expectations for drilling activity based on languishing oil prices, although gas and LNG are seen as growth areas. Now, Liberty Energy, the big winner this week, EBITDA coming in ahead of estimates, although the company did guide towards a weaker second half, driven by lower completions and weaker service pricing. Baker Hughes and Technip also up double digits on the week. And next week, we'll start hearing from producers and their capital spending plans, which will give further insight into how the services names look amid the second half. Scott?
All right, Pippa, thank you. That's Pippa Stevens, right to the bell, ringing in new records yet again. Closing highs for the NASDAQ and the S&P 500. Dow's not that far away. It won't get there today. We'll see you on the other side of the weekend into OT.
That bell marks the end of regulation for the week. Manchester United ringing the closing bell at the New York Stock Exchange. Namib Minerals doing the honors at the NASDAQ, and it's another record close for the S&P 500 and the NASDAQ, which is higher for 5 out of the last 6 weeks. The S&P closing at records each day this week. First time it's done that in almost 4 years, back to the go-go days of late 2021. Healthcare rebounding. It's the top sector this week, posting the biggest weekly gain in nearly 2 years as investors buy some of those beaten down names. And oil services stocks, big winners, Baker Hughes and Liberty Energy posting their best weeks in roughly 2 years. That is the scorecard on Wall Street, but winners stay late, especially Fridays. Welcome to Closing Bell Overtime. I'm John Fort. Morgan Brennan is off today. Palantir is the best performer in the S&P 500 over the last year and closing at another new high. We're going to hear from an analyst who just started coverage and says investors should keep buying this red hot name. Plus, speaking of late 2021, meme stock mania returning this week with a fresh batch of names. Can it last? And what does this risk-on attitude mean for the broader market? And later, Coursera soaring today, up, let's see, more than 36% on strong earnings and guidance. The online learning platform CEO joins me in an exclusive interview. But we begin with Christina Partsinevelos looking at the stocks driving today's record-breaking action. Christina.
John, let's start with the somewhat turnaround for Tesla. Shares tumbling, 8% earlier this week on slow quarterly sales, but getting a bump today on a Business Insider report that the EV maker's robo-taxis will debut in San Francisco this weekend. But we are just hearing that California regulators say Tesla is not allowed to test or transport the public, paid or unpaid, in an autonomous vehicle with or without a driver. So we'll see what happens. The stock didn't really react too negatively once that came out. Shares are still down 4% on the week. Insurance giant Aon popping to its best day since October thanks to better margins and a stronger cash flow, up about almost 5% on the week. Estee Lauder gaining some love from JP Morgan analysts, the firm pushing its price target from 62 to 101. They're optimistic that restructuring and stronger digital execution on platforms like TikTok and Amazon could drive a sales turnaround this holiday season. And lastly, a rough day for cable news stocks. Charter Communications plunging to its worst day ever after losing 117,000 broadband and 80,000 video subscribers last quarter. That decline is dragging down on peers like Comcast, Altice, Dish parent EchoStar. Unfortunately, and I don't like to say this because we work in TV, as cord-cutting pressures just intensify, John.
For the record, the cable part, though, not the news part. Christina, thank you.
Yes!
Well, let's get to Rick Santelli now for what's driving Treasury yields lower today. Rick?
You know, it's a lot of this is pointing towards Fed meeting and the fact that things going on overseas, the ECB at the end of his easing cycle, all figuring in. Let's look at the 2-year and 10-year since the last Fed meeting. You can't make this stuff up, John. We're basically unchanged with levels from the 16th and through the 18th of June, the last Fed meeting. It was at 394 the day of the Fed meeting, and a 2-year, we're at 392 now. A 10-year was at 439. Where are we now? 438. And if we look at bond yields, 2-year bond yields, that chart starts on April 1st. And you can see that with the ECB potentially done easing, that 2-year jumped up almost to 2%. And finally, nothing says risk on like a high yield market. This is the high yield ETF, HYG. It is hovering right now near the best levels since April of 2022. John, back to you.
All right, Rick, thank you. Well, for more on the market now, let's bring in Capital Area Planning Group Managing Partner and CNBC contributor Malcolm Etheridge. Malcolm, happy Friday. Well, let's step back. The S&P, again, hasn't closed at highs like this every day since November 2021, which is just before the index peaked and took years to recover. Are these highs, combined with the meme-ish mood, a good sign or a bad one?
Well, I think it's probably a good sign that the meme-ish mood hasn't gotten as out of control as 2021, right? If you just look at the volume in a lot of those names you guys had up on the screen earlier, it's not nearly as close to what we saw in GameStop and AMC and a couple other names that got sprinkled in. For one thing, it is a little bit spread out, the bets that folks are making, trying to hit that home run. But I also don't think that there's enough staying power in this meme mood, because what we're seeing in my estimation is investors who have done really well since Liberation Day in tech stocks, taking those gains and then looking for another place to park those gains for a little while the market is at all-time highs, like you just said. So I think what we're going to see is a return back to retail's favorite names, the NVIDIAs, the Teslas, names like that, about a month from now, where those meme stocks will cool off and we won't be talking about meme mania the same way we did in 21.
Well, even those favorite names are pretty hot. What does a balanced portfolio mean right now in 2025 with the indices where they are? And what's the alternative to selling stocks and going to cash if you're queasy about these highs? Because trying to time the market usually does not end well.
Yeah, John, it's almost a curse word right now talking about a balanced portfolio or diversification. Folks just don't want to hear it because the market is doing so well. And right now, everything is consistently going up and to the right. But I think to your point, this is a great time if you were a person who was extremely concerned back in March, April, saying things like, I don't like the way the market looks and I'm considering getting out. I think I might need to sell something. I think I might need to make a move. You're being given an opportunity to exit before things actually start to get choppy. And the trade scenarios aren't all solved, right? We were talking about 90 trade deals in 90 days or something like that. So the pause that's about to come undone in the next couple of weeks here might return us to a place where investors start to get worried again and you see that trade coming back down. So I think anybody who is riding high right now, feeling great about the gains they're seeing in their portfolio, but just 4 months ago was extremely concerned about where do we go from here because the market had fallen almost a perfect 20%. I think this is the gift that allows you a space to be getting out.
So correct me if I'm wrong here, but I think if at the end of last year, as an investor, you had taken some off the table of your domestic stock exposure and said, hey, I'm going to buy international stocks instead, you might actually be doing better, and not all of it off the table, but some. You might actually be doing better than the general, like S&P, even though the S&P has been doing great. So are international stocks, even international ETFs, still a decent bet at this point, valuation-wise, based on what we see happening in trade and other economies?
Yes, and I think you could even take the same trend that we're seeing here in the U.S., where for the first couple of years following ChatGPT's release, American tech companies were dominating with their large language models and what they were able to create. And then you saw with DeepSeek back in January, with open source models, companies were able to create a lot more that allowed developers to do a lot with a little. And I think that theme is carrying through parts of the EU. It's carrying through parts of Latin America, even, and also some of the Asian countries. So I think being invested internationally in tech specifically is a great place to be because it's unlikely that the U.S. continues its dominance in that space with the AI trade. However, we know that the AI trade has to continue to go because you have companies like a Meta, for example, who's investing $80 billion a year, or Microsoft, $80 billion a year. We just heard from Alphabet that they're increasing their CapEx spend by $10 billion. So that definitely means that this trade is going to continue for some time.
Looking at some emerging Asia type funds, China used to be the not just the tail that wags the dog, but maybe the whole dog with those kinds of funds, but doing pretty well actually right now. Can investors think of that as perhaps a place to put some money, emerging Asia, around that whole region to diversify away from high valuation U.S. exposure?
I wouldn't consider it an investment like you just said. I wouldn't consider it a place to put money longer term that you're expecting to see, a reasonable amount of volatility. If this is speculation, then yes, by all means. China's still one of those places that we just never know whether we can trust the data that we're getting. We as American investors are legally not even allowed to invest directly in Chinese companies. And so with all of those dynamics underpinning ETFs and everything else that give you exposure to China, it's a great place to place a few trades just to see what happens. But it's not necessarily a great place to be allocating a meaningful amount of the dollars that you're going to need to rely on in retirement, say, for example.
Duly warned. Malcolm Etheridge, thank you. Well, let's turn now to utilities. The sector hitting a record earlier this week, but those stocks aren't trading like your father's slow and steady utilities portfolio, at least not recently. Our Pippa Stevens joins me now with more. Pippa?
Hey, John. So utilities are a snoozy area of the market no more. Once viewed as simply a bond proxy, that relationship is now actually breaking down. The correlation between the XLU and long-term treasuries is now at the lowest level in nearly 5 years, thanks in large part to power demand growth from artificial intelligence. Within the sector, the independent power producers have led the way. That's names like Constellation, Vistra, Talon, and NRG, since they have direct exposure to that growing demand. But Mizuho's Anthony Crowdell said the breakdown in correlation could also be investors beginning to view the sector in a new light, specifically as growth stocks. He noted companies are now averaging 7% growth after years in the 3% range. That means that utilities are now providing S&P 500 level growth while trading at a discount to the overall market and also offering a better yield. All told, total, the sector is expected to grow earnings by 15.7% this quarter. That's according to FactSet. And as results begin to roll in next week, key themes to watch include capital spending plans as well as load growth estimates, especially after this week's PJM capacity auction showed the Mid-Atlantic and East Coast is drastically short power. John?
Pippa, I want to get this wisdom from you while I can. What are the signs that it really would be different this time with utility stocks? Because it seems kind of risky to think, okay, well, they've been slow all this time, but now all of a sudden they're growth stocks.
Well, I think what we really have to look at is the fact that load growth is rising, and that is at a meaningful growth now trajectory for the first time in many decades. And there is no really debating that when you just look at the things like AI, of course, reshoring and electrification. But I do think that what's been emerging within the sector is kind of this tale of two cities, if you will, when you look at the IPPs, those companies that have that direct exposure. A lot of the gains have been driven by those companies, and those are the names that investors really no longer see as your traditional utility stock. If you look a little bit down further, things like the regulated names, the fully integrated ones, as well as the transmission and distribution names, they haven't participated in that same level of rally simply because they don't have that exposure to AI. And so I think for there to be a confirmation of a rebirth, as it were, of the sector, we need to see some of those laggards catch up as well. But of course, they are beholden to their regulator. And so it's a little bit of a different profile from an investment standpoint when you look at the possible returns ahead, given that they are ultimately capped. John?
Great, deep insight. Until next time, Pippa Stevens, thank you. Well, my next guest says this mystery AI stock was born to be wild, and it is initiating it with a buy rating, even though this stock has doubled already this year. He's going to explain why investors should be buying on any pullbacks. Plus, Mag 7 stocks Apple, Amazon, Microsoft, Meta. They're the big names to watch on next week's earnings calendar. Coming up, a top technical strategist is going to break down all four charts and how you should be trading ahead of those results. Overtime's back in 2. Welcome back to Overtime. Shares of managed healthcare provider Centene jumping today, despite reporting a surprise quarterly loss that saw membership decline across its Medicaid and Medicare business. It was up 6%. Revenue did top analyst expectations. The company CEO saying it was disappointed by the results and was, quote, working with urgency and focus to restore its earnings trajectory. But shares could be getting a boost because the company did say it expects margins to improve next year. Still, the stock's on pace for its worst month ever ever, down nearly 50%, and it is the worst performing stock in the S&P this year. Well, from worst to best, Palantir extending its recent strength, hitting a record high today. The stock is the top performer in the S&P 500 this year, climbed all the way to the 20th spot in the index by market cap. The run still has legs, according to our next guest. Joining me now is Brent Bracelin. He is co-head of technology research at Piper Sandler, has an overweight rating, $170 price target on Palantir, the highest on the street. Brent, that's a bold move coming in on this one after it's been moving this much over this period of time. What gives you the confidence that it can grow into this valuation a la NVIDIA?
Yeah, I mean, I think what we've learned, let's say over the last couple months that we've been doing more due diligence on the company is this is more than a meme. This is a real business. When you go to a SAP Sapphire event, see meetings around SAP and Databricks and the role that Palantir has there, and standing room only sessions. When you go to Databricks AI Summit and you see standing room only sessions of large enterprises, that's not even their main market, right? Their target market is government. And so a lot of our due diligence and bullishness is really looking at a longer term picture. How big can this company be? What's the art of the possible? And if you think of the art of the possible here, $2 trillion TAMs that they're going after, government, there's a massive secular shift from big machines, proprietary software, to small machines, drones, AI. We are in the early innings. We have this $2 billion government business.
Okay.
We think they could 5x to $10 billion on the enterprise side. That's $1 billion business. We think that could 5x as well. So early days.
What are the signals
what we're
then?
underwriting is a longer term opportunity.
What are the signals then in product and strategy within Palantir that they are both consolidating the lead that they've got thus far in this enterprise AI lane where they are, and expanding? Does it have to do with developer tools? Does it have to do with platforms, unique environments that they're going to build? That's part of the enterprise software playbook, but I don't know if they're going to follow that traditional playbook.
There's nothing traditional about this business model, management team, or approach. So unconventional is the right label here. And I think 5 years ago, when we looked at this business, we put it in that data tooling kind of space. As we've done a lot more due diligence, talked to customers, talked to partners, those former competitors are now partners. Both on the defense side, where they compete against prime contractors, they're now partnering with the primes. With data companies like Databricks, they're not partnering with Databricks, right? So I do feel like the signals are competitors turning into partners, number one. Number two, if you look at just web traffic trends, if you look at like the acceleration you're seeing in web traffic trends going to the website here, the pace is very similar to Palantir, as you're seeing the web traffic trends at ChatGPT, the web traffic trends you're seeing at Anthropic. And so it looks like those signals there are matching up with what we think will be an AI secular winner, along with some of those others.
We were just showing on the screen the government revenue growth, and Palantir does have a great exposure to government revenue because it's won a lot of that business. But aside from that, from a strategic point of view, what's the biggest risk to Palantir, either a technology-based competitor or a shift in trend that would potentially upend your move here?
Listen, government's a little harder. I'm not a government specialist, right? So that's a little bit of a black box for me, but you can see the awards stacking up that gives us confidence that business can get a lot larger. You have this secular shift from big machines to small machines and AI software. On the enterprise side, what could go wrong? What's driving that business? 30 years, we've seen the pendulum swing away from custom software towards prepackaged SaaS. What needs to happen is you need to see a shift away from prepackaged software to custom. And if that happens, I think that's what's fueling the growth for Palantir. If that pendulum doesn't swing back to custom builds, where a city builds their own custom app on top of Palantir, where a Wendy's builds their own custom app on top of Palantir, if they go back to just buying prepackaged software, that growth profile will be wrong. That's where the risk lies. So that's the secular trend you're betting on here with this one, is more enterprises with their own proprietary data, with this ontology logic layer delivered through Palantir, they can build their own custom apps. That's what
I love how clearly you articulated that risk. You're watching your blind spots. Brent Braceland from Piper Sandler. Thank you on Palantir. Well, Coursera getting an A+ from investors today after soaring on an earnings beat. Strong revenue guidance. Up next, we're going to hear exclusively from the online learning platform's CEO. Plus, is the meme trade back for good? Well, was it ever here for good in the first place? What that could say about the appetite for market risk. That's coming up on Overtime as well. Be right back.
Plus.
Welcome back to Overtime. Shares of UGG bootmaker Deckers Outdoor jumping, and it's hard to jump in UGGs. After a top and bottom line earnings beat, the company citing higher than expected sales of its flagship brand as well as its Hoka shoe and sandal line. Decker says it started raising prices on some of its shoes by around $5 to offset the cost of tariffs, planning to add more increases throughout the year. Management saying it was also considering hiking prices for not yet launched designs. Well, a huge day for education technology company Coursera as that stock pops 36% post-earnings. I spoke exclusively with new CEO Greg Hart, who started in February, about the trends that led to the beat.
I think what we're seeing is that, number one, a few years ago, when GenAI first came out, we were very quick to start both getting content around GenAI so people could learn about it, but also leveraging it as a tool. And so we have a bunch of different functionality on our platform that helps learners and leverages GenAI to do that. So Coursera Coach, which is an AI-driven tutor that helps people go through a class, really helps them if they're struggling. And so we see that learners who engage with Coursera Coach have higher course pass rates, higher quiz pass rates. We also see that more first-time learners and women engage with Coach, and so it levels the playing field as well.
Hart said Coursera is both selectively hiring people to fuel growth and using AI itself to stay lean.
One of the big themes that we've had since I came in is how do we make sure that we're taking a product-led approach to growing that really is deeply rooted in understanding our customers and our need and their needs, and then how we can do a better job of serving them on the platform. So we're absolutely continuing to invest, but also leveraging AI to drive efficiencies. And I think you see that reflected both in the revenue guidance, but also in the fact that we're delivering operating leverage with the adjusted EBITDA margin also increasing.
Finally, I asked him what the key difference is between a player like Coursera, which is benefiting from the AI surge, and edtech companies Chegg, which has been gut punched by it.
Well, I think for every industry, that is the $1 trillion question. How do different companies in a given industry, whether that's education, technology, or other industries, leverage AI to their benefit, and how can they make it a differentiating factor? Well, I think there are a couple things about our particular approach that make it a little bit more durable and a little bit more differentiated. In an era with Gen AI where the ability to create content has never been easier, I think the value of content from trusted partners like our university partners, like our industry partners, the Googles, the Metas, the Microsofts, the IBMs, deeplearning.ai of the world, has never been higher because it comes from authorities and experts, and those are well-respected brands.
After today's move, Coursera at levels it hasn't seen since the spring of last year. Well, time for a CNBC News update with Kate Rogers. Kate.
Hi, John. The Education Department announced today it will release the remainder of previously frozen grant funds for schools. Earlier this month, the Trump administration withheld more than $6 billion in funding. It then reversed its decision last week when it released $1.3 billion of the money that would fund after-school programs. Today's money goes toward programs such as adult literacy and English language instruction. FEMA is starting a program that would send $608 million to states to help build migrant detention centers. The agency said today states have until August 8th to apply. Earlier today, Florida Governor Ron DeSantis said the state will apply for those funds to pay for the detention center dubbed Alligator Alcatraz. FEMA did not say if Florida would receive the money. And more than 100 NFL players are facing fines for selling Super Bowl 59 tickets above face value. The Associated Press reporting players will have to pay 1.5 times more than what they paid for the tickets, and they cannot buy tickets for the next 2 Super Bowls unless they're participating in it. Back over to you, John.
All right. Kate Rogers, thank you. Well, up next, Interactive Brokers chief strategist on the return of meme stock mania this week and what that could mean for a broader market that keeps hitting new highs. Plus, Apple's been outperforming the rest of the Dow this month, but it's still down 14% this year. Coming up, we'll break down the charts to see whether next week's earnings from Apple could fuel this recent rally. We'll be right back.